Okay, quick Thursday morning radar update. Not done one of these for a while. Been very busy in the background. So I just thought I'd just run through a few markets this morning, and we'll have a quick delve into what's happening. So you might have noticed that the European markets and the UK has been doing pretty well. You know, these risk-on markets, the smaller caps and the 250 over the last 5 days are, bottom left to top right. And compared with the US, the US is just wide sideways action in a range. Easy for me to say. But let's just buzz through these markets. One thing I'm just going to note here is that we've been seeing really good volume yesterday and today Tuesday and Wednesday in UK stocks, which could be just a little bit of window dressing, the beginning of the month. It's dropped off today, but the previous 2 days it held right through lunch with many on the screen. So we'll have a look at that as well. Transports. Things to note here. Should I just zoom out a little bit on these markets? So if you read my piece on the big market levels in ShareScope in May, we put these targets in for the markets. The markets have all come into these target areas, and basically they bounced off the lows again. The strongest market landed last, as we talked about in the article. It's usually the way. And you could say with market corrections or bear legs, the strongest stocks land last. And, you might be looking at Apple that way, or, if you think Apple's a stock what should hold up, Apple coming into once everyone start to talk really, the frothy, worried holder kind of scenario where when the stock gets really sort of whacked, that might be where the market finds its low. At the moment, we're off the lows, aren't we? The weakest markets are the risk-on markets, and the strongest markets are the your DAX and your FTSE 100 and your Dow Industrials. These the big cap weighted markets. So that's kind of a risk off kind of thing anyway, isn't it? Money flowing into those markets. But it's good to see the risk on the risk market, should I say, just seeing a little bit of interest. The bull case for me is, we've come into some levels of interest, what I would say are real levels of interest. I mean, look at that level on the Dow, industrial, sorry. And, there's just some big levels of interest here, and we've come into them all. I know we've bounced off them. I mean, look at that strong bounce off that level in the industrials. And the bull case for me is we're starting to carve a bottom out here, and the market will, the low could be in, even if the news is absolute, that it's kind of terrible out there. The sensible, more conservative sort of argument would be in my, if the oil price takes pressure off everything, and if the oil price just comes back and sits in a happy range, that would be good for everything. It's the fastest way to sort of stimulate the markets, isn't it? But also, just the oil demand as we move out of winter, and we're not even into the coldest months of winter yet, so that would say to me, well, maybe it's going to happen later than earlier, but the first quarter could be pretty grindy. Who knows? I always just sit at the right hand edge. I run my screens every night, and if the risk model lets me take a trade, and the trade what pops up on those screens is one I the ones what let me sit here, the ones what I have to take. I will keep nibbling at these things, and if they trend into the distance and free up heat, I will nibble at another one, and that's how we get, basically invested, no matter what our market opinion is. That's how we do it out of the pandemic. That's how we did it out of the US elections and the Brexit vote. That's how I did it out of 2000, the awful market of 2011 and 2012. And that's how I did it out of the GFC in stocks. Before then, I wasn't in stocks. It's always the same. It's markets could be way off the lows before the stocks actually start to throw constructive setups en masse, but there will always be constructive setups showing up. So, it's just going back to that article in May. It takes time, I always tend to talk about things that I think about. I lie in bed and have a think about a few things, and I was thinking about people's sort of time frames. A lot of new investors come in the market and they want to take a trade. What will pay them, handsomely in probably a week. If they get a fast profit, they will snatch at it. But the reality is, the trades what really make the difference. They're the ones what last for a year or 18 months. The average outlier trend would be up in that 14, 18 months area. And that is the way it is. Go and have a study Ergo or CER or some of the ones from the W80 or some of the ones from the last leg we rode. So, you've got to sort of it's something to think about, isn't it? Your time frame. If you're just coming in the market for a bit of fun and you want to see your account whip up and down, you're not going to be positioning for when it's just going to be a very different sort of thing you're trying to capture, isn't it? Anyway, moving on from that. There's the off piece for the morning. Lots of volumes have been hitting the screens. The FTSE 100, talking about that last night, a lot of people might be sort of beating on about how your money should be in the FTSE 100 last year. It's another decision, isn't it? Do you trade stocks what don't trend and they just basically hold relative strength in a really bad market, or do you trade stocks what, they correct? More volatile stocks correct, don't they? And you don't hold on for that. I hold through a correction, but I don't hold through a bear leg. So, it swings and roundabouts, isn't it? It's kind of rear view. So going forward, I like to talk about the higher beta sort of stocks. I like to weight at least 60 to 70% of my accounting. 2/3 of my account goes into the higher beta sort of small caps. Two-thirds of my active account, I would say, what I manage. And I'm already exposed to what the FTSE 100 did last year, just by dollar cost averaging a pension, and those shorter term ones, I'm like a sniper, just very looking for the best opportunities. That would be swing trading. Also, if you shared my last piece from ShareScope, go and have a look at that on ShareScope. If you haven't seen it yet, cheers for sharing it. Moving on, let's just jump into the volume leaders and just see what's on volume today. I should have pressed that button a few minutes ago, shouldn't I? Terrible internet here recently. So it is 9:30. We should have traded about 18% on, to be on average volume, which would equate to about 26% to be on conviction. Yeah, I tell a lie. We're doing okay again. looked a bit light on the last run, but there's quite a few in the screens again. It was actually a little bit light last time I ran it this morning, but so if I run through these, we've got one page up on volume. There's a few investment trusts getting some love there. Rolls-Royce obviously broke out a while ago, a few days ago, out of this little I call it a bit of a mini base. Return to pre-tax profit on that one. Let's just bypass those investment trusts and just have a quick look. You know, I always say, I'll just repeat this as well. You get, when your stock trades 52-week lows, you get to, you get lots of time usually to make a decision. And, this one hung around in this area for maybe a month, before 1, 2, 3, 4, 5, 1, 2, it's probably in this area, in this little zone, close below, for about a month before it rolled over and absolutely got spanked. So, we call this last chance saloon. You get to make a very, if anything, focus, stocks you hold when they hit that area. Just remember that, from that very low area and what people think is a low area, 52-week lows, the first visit to that, your stock can still lose 100% from that level. And if you go back and look at all the stocks what broke trend this year, they got out absolutely whacked. No matter what the value, no matter what the fundamental case, when it's time to correct, even the best half in price. And not saying they all did it in last year's market, but they all will do it. The only ones what don't correct is the ones what get bought out. And they usually get bought out from after a correction, don't they? So I'll just buzz through these. Ergomed, it's just gone sideways ever since, I'd rather be looking at a stock like this from up here. It's not the same stock. I'll say it's not the same stock. I didn't ride the first move, but I know some of my group did. They rode this one. I got involved sort of up here. I cheated it and then bought it. And take the log scale off, you can see the reward to risk. The reward to risk was absolutely huge on these trades. So, that's what I'm trying to get invested in for the future when they come around. Got a few on actually, just only a very low invested. I've been extremely low invested. If I took swings out of the equation, I've been under 15% since probably March. As soon as we got, I think we was pulled out of all the big winners in March, weren't we, last year? So I've been extremely, very low invested. No anxiety all the way through that market. So anyway, these are today's volume leaders. Obviously, you'll see a lot of these volume leaders went through the screens prior. This one was very low on my list. It threw a swing style entry, but it was probably a page 3 for my list of swing point end of day screens. But yeah, it's up into that area. The reality is, what I want to show you on these trades actually is how efficient these main market ones are. So today the news feeds and everyone will be pumping this stock, and anyone who's got a position will be pumping the life out of it. But for someone who's thinks NXT looks interesting today is probably the worst day to even think about being involved in it. And I'll just show you that. Let's just jump onto a TEP, Telecom Plus. And there's that, very sane decisions were made up here. 52-week lows, look when it traded those lows as well. Mid 2019. And you know, missed out on a whole bull market, didn't it? Moving on. Probably disappear, probably disappear, this stock. Wouldn't surprise me. Anyway, let's move over to TEP. I think I just saved it in here. So, we talk about main market stocks being efficient stocks, and that's exactly what they are. The main market stocks swing up and down with the market. The market affects these more. Small caps will swing twice as volatile as these, but position sizing deals with that. But another thing, small caps, what have got a reason to trend, can do against large caps, what have got a reason to trend. But you've got to remember, large caps have already made it. They've already made it into the top markets. Being in the 350, it's kind of already made it, hasn't it? Definitely into the 100 in the UK. So even if it's got a reason to trend, it's still going to stair step. Very few don't. Now, when people show you technical analysis, they will show you that holy grail, the very few what don't, and they'll say this is how you get on a trend, and they'll use the best opportunity, the best one to show you. The reality is, if you took that trade 100 times, maybe 5 at maximum would trend off into the distance without trading normal action. And this is normal action. So, breakout, pullback, and then it went on a move. And this was a really good move. And I'll say it was in the top of my GTRS. And it's still up there now. Now, it came back in, it corrected really orderly, but long. It came down into the 10-month average. And then, we got a news gap. And it put in this here. And this is where everyone's going to be talking about it. These 2 days here. This is where all the news feeds will be spoon feeding you what you want to see. And then this is what happens. We get the normal action. And this is when we had it on our site. And this is when we put this target of 24, 22 in the market. So that's what we call a swing trade. Normal action, pullback, 50%. It even gave up the gap, and everyone would have been saying gap fill, But this is a pro gap. We call it the gap test swing point. I call it anyway. And then off it goes on its journey here, and everyone's talking about the breakout. And it's an efficient stock. It's a main market stock. What does it do? It comes all the way back in. Maybe it'll roll over and die. Maybe we'll see it in the swing screens again. It is what it is. But that's what efficient stocks do. And if you've got a small cap stock, what's inefficient with exactly the same fundamentals, I'll just use Ergo as the same. It was right up there in my GTRS. They can do the opposite. They can just go up, and you can say, well, it corrected here, but it's half the correction of. We shouldn't talk about percent corrections. We should talk relative to the stock's price action. And it's like when people say if you lose 50%, you've got to make 100% to get back to break even. It's kind of on a portfolio basis, 10% is a maximum you should ever have to expose the account to on drawdown. At one time, paper cuts will take you down into the 20s or whatever. But, on a stock basis, it's about price action. It's not about, because small cap stocks whip up and down 30 odd 40%. Main market stocks whip up and down kind of 15, 25%. It is what it is. They're more volatile. You make more money on good trends, but inefficient stocks can do this. So that's basically what I'm trying to say against efficient stocks, what are You know, the fundamentals can be fabulous, but very few of them will go on that straight, you know, compared to an inefficient stock. So lots in there today. It's Educational Thursday. Okay, cheers all.